Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, welcome to this episode of Through the Noise. I am your host, Ray Heung, Senior Investment Strategist with the bank's CIO office, and I'm very happy to be joined by Manpreet Gill, our CIO AMEE. Welcome Manpreet. Let me start with the first question. I recorded in February, we had initially discussed a limited Middle East conflict being our base case. Is that still your thinking today?
Hi, Ray. Thanks for having me on. To some extent, yes. So, in our base case, we do expect the ongoing move towards conflict de-escalation to continue in the coming weeks, albeit with bouts of headline volatility. Having said that, the tail risk, of course, of an unexpected resumption of hostilities, to our mind, still remains present, at least for now. Now, from an investor's perspective, financial markets thus far seem to agree with us. Right? Despite the Middle East conflict, US equities have achieved new record highs after what has been only a relatively modest pullback, and that's coincided with an easing of oil prices, initially to below $100 and now back maybe in a narrow range around that. And we've, of course, got a related easing in US bond yields and the US dollar. Now, of course, we always try to avoid extrapolating straight line gains, but overall, if this direction of de-escalation continues, we continue to expect equities and gold to outperform bonds and cash. Now, the threat of inflation is undoubtedly likely to be an area of focus over the next couple of months. However, we expect the global economy to avoid a sustained rise in inflation. Now, in the US, that should allow the Fed to still achieve one rate cut before we end 2026. Though in Europe, the more inflation-focused ECB is likely to raise rates, albeit only once. Now, that said, from a bond market perspective, we still think markets may be, somewhat excessively overpricing the extent of central bank hawkishness, and that, in our view, creates opportunities to lock in rates, particularly when it comes to short and intermediate US dollar bond maturities.
Thank you, Manpreet. I think one of the key things, obviously, is in the Middle East that is driving the oil prices situation, right? So can you tell me a little bit more about our oil price scenario? What are the risks investors should be paying attention to?
Well, you're right that one key assumption behind many of our views is that oil prices continue to drift gradually lower in the base case that I'd outlined. But having said that, there are two reasons why we think a quick return to pre-conflict oil prices is unlikely. First is just the time needed to fully resume Middle East oil and gas output. Even if the Strait of Hormuz is reopened quickly, shipping will take time to resume and damaged facilities will take time to repair. Second is that inventories will need to be rebuilt, which of course adds its own new source of demand in the coming months and years. So together, that's why even in our base case, we're revising our WTI oil price forecast slightly higher to a range of $80 to $90 per barrel over the next 1 to 3 months and $70 per barrel over a longer 6 to 12 month horizon. Now, you're right that a downside scenario of renewed hostilities would likely result in a surge in energy prices, and that remains a key risk. However, compared to the 1970s, it's worth pointing out that the global economy is considerably more energy efficient, and the oil price rise in the current episode has remained below prior highs once you adjust for inflation. So when you put that together, we expect the risk to be manageable unless prices really settle at levels well above $150 per barrel.
Sounds good. So if we are trying to pooling all these together, seems like we are still fairly constructive on the global equities. Can you tell us a little bit more about the regional preferences today, especially in light of the higher level of oil prices?
Sure. So I think first and foremost, we remain overweight US equities. This is, of course, a region that has outperformed other major regions throughout this current period of hostilities, including in the rebound. In our view, this is because of the US economy's relatively lower dependence on Middle East energy compared with Asia and Europe, and what continues to be a fairly strong earnings growth outlook. Now, a more significant inflation shock would, of course, have been a stronger headwind for US equities. However, we believe that easing energy prices and what has so far been well-behaved long-term inflation expectations from the market, together with what we see as a softer relatively soft job market will allow the Fed to stay on hold and resume rate cuts before year end. So, in our view, this means equity markets are expected to continue their focus on earnings growth. And over here, data remains very strong. So, Q1 26 earnings have, of course, reinforced market expectations of full year 2026 earnings growth being strong at a pretty high 19%. Now, we do expect the technology sector to maintain its lead, especially after the recent valuation derating, light investor positioning, and what's been a recently positive set of catalysts in terms of funding commitments and improving pricing power. But alongside that, we're also raising this month the US communication services sector to overweight on what we see as an improving digital advertising environment and expanding opportunities to monetize AI investments. So that's, of course, on the US. But we're also holding on to our overweight on Asia ex Japan equities. Now, no doubt, this region remains more sensitive to energy prices. So, any renewed rise in tensions would create risks for both economic and corporate earnings outlooks. However, in a world of what we see as a flat to lower oil prices from this point forward, we're really looking on two catalysts to pick up the slack. First, of course, is strong technology sector earnings, which should spill over positively, most so to North Asian equities. And second is the resumption of US dollar weakness, which has always been, in our view, consistent with further outperformance of Asian equities. I will point out, though, within Asia, we're maintaining what we view as a bit of a barbell regional preference. We have an overweight to China and Taiwan equities, which should benefit from strong technology sector earnings and a renewed focus on the AI theme. On the other side of the barbell, we're overweight Indian equities, which arguably has relatively little direct exposure to AI, but should benefit from what is, in our view, very light investor positioning, well supported earnings growth, and what we expect to be gradually lower oil prices and a weaker US dollar.
Thanks, Manpreet. Let's make a stop on bonds after we discuss about equity. So what about the bond yields? And where should investor considering adding risk?
So I think when it comes to bonds, one cornerstone of our view is that we expect long-term inflation expectations to remain stable. So what this means is that if we do get any rebound in bond yields, we'd view those as temporary and as an opportunity to lock in the yield. And as I mentioned before, particularly at the short to medium parts of the yield curve, as the broader US dollar yield curve re-steepens, because we see central banks delivering slightly less tightening than what markets are currently pricing. Now, within bonds, of course, we're keeping an overweight to emerging market bonds, both in US dollars and local currency terms. And credit spreads did widen to some degree in response to the Middle East conflict, but since then we've seen those spreads retrace most of their move. Now, looking ahead from this point forward, emerging market bonds, in our view, should benefit from renewed risk appetite and a softer US dollar, particularly if the conflict continues its slow move towards de-escalation. However, we should acknowledge that they remain vulnerable to our downside risk scenario should oil prices surprise us and surge once again. The one thing I will point out, though, is that we have trimmed our view on developed market high yield bonds back to neutral or a core holding, following what we see as a rise in valuations. Credit quality, the yield all remain attractive, but we just see better risk reward today in our short duration US high yield bonds opportunistic idea.
Thank you, Manpreet. If I may just recap, I think the market remained resilient and the Middle East de-escalation expectations, with equity hitting new highs and yields relatively stable. I think headline volatility will persist, but the base case actually still supporting risk assets. Number two is that, well, in terms of the asset class, we overweight US and Asia ex-Japan equities, which is supported by strong earnings, easing inflation risk, and a weaker dollar. And then to the bond side, we prefer short to intermediate tenor for bonds. GM bonds remain fairly attractive, and DM high yield, despite trimming to neutral, we still like the fundamental on that side. We also think that oil unlikely to revisit the pre-conflict lows in the near term, but it's also not likely to be over $100 per barrel sustainably. We are seeing WTI 3 months target to be around $80 to $90 per barrel, and for longer term, a 12-month horizon at around $70. That's all the time we have for today, and thank you for listening. The global market outlook for May is actually now published, and please check out for more details. And we will talk to you in the next episode of Through the Noise. Bye now.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.